Welcome. It's the estate planning strategies for the 2020 election. My name's Paul Bernstein. I'm an attorney. For those of you that don't know me, I'm a certified estate planning law specialist, board certified estate planning law specialist, as well as an accredited estate planner. I founded my firm, the Bernstein Law Group, in 1996. So we're coming up on our 25th year anniversary next year. We have offices in Beverly and Woburn, Mass. However, since March, we've been operating 98% virtually, rarely meeting with clients in person at this point. We're using a Zoom, and that has worked really well. We're at 100% capacity, just not physically meeting with most of our clients. Our firm itself is a very focused firm, boutique practice. We help clients with traditional estate planning as well as advanced estate planning, business planning, asset protection planning, and probate and trust administration. Just before I get into the main topic of today, just real quick housekeeping items. I'll keep this as close as I can to end at about noon. It'll probably be a little bit longer due to our technical difficulties, but I'm very mindful of your time. Also, please feel free to ask questions in the chat, but I won't be able to review the questions until the end. I'll make certain that I spend some time answering your questions. Now, where we are now with the 2020 election is almost here. In fact, I read this morning that 17 million people have already voted, so I guess we're actually in the election period. On the federal side, as recent history has taught us, trying to predict the results of the election can be futile at best. Still, as professional advisors, we need to keep our clients as informed as possible when it comes to potential tax changes on the horizon. We don't know for sure what the future holds, but they're pretty strong clues of what will happen if there's a shift in the balance of power in Washington from Republican to Democrat. And even if there isn't a dramatic shift or a sizable shift in power down in Washington, some of these tax reforms that we're hearing about may still come to fruition as Congress and the president struggle with decreased revenues and increased spending due to the pandemic. So where are we now? So we're in a time where the Tax Cuts and Job Act, which was passed in 2017, is in effect. From under that act, the law increased the estate, gift, and GST, generation skipping transfer tax exemption, from a base of $5 million, which was set in 2011, to a base of $10 million. The estate, gift, and GST tax rate also is at a flat 40%. The exemption amount is adjusted for inflation annually and is currently at $11.58 million for 2020. A married couple effectively has $23.16 million of combined estate tax and gift tax exemption and can utilize that with proper planning. There's a notion of portability. Unlike the estate tax exemption, the GST tax exemption is not portable between spouses. This higher exemption amount, the 2017 Tax Cuts and Job Act, the provisions regarding estate taxes, gift, and GST taxes is scheduled to sunset, which is a nice term for decrease, on January 2026, a little bit more than 5 years from now, to $5 million index for inflation, unless there's a change that occurs sooner. Presidential candidate Joe Biden has said that the estate, gift, and GST tax exemption could be set as low as $3.5 million per individual, basically returning to what it was prior to 2011. And the exemption actually for gifts could be set as low as $1 million. And the rate could increase from the current flat 40% to 45 to 65% range. In fact, Bernie Sanders has proposed a progressive estate gift and GST tax rate starting at 45% and topping off at 65%. If the exemption amount does drop to $3.5 million per individual for our clients that are married, this is a reduction of $16.16 million versus what they have today. And a tax increase, if their state exceeds that, is at the level of that $23 million amount, it would result in an increase of the estate tax exposure to these clients of about $6.5 million. And that's at a 40% estate tax rate. If that estate tax rate increases, that $6.5 million exposure also will increase. One good bit of news we received last year from the service is they finalized regulations on what's known as the anti-clawback rule. Just to let you know what the issue is regarding this clawback was, let's say a client gifted $11 million this year to family members and used up most of this client's exemption. And let's say the client died some years later and there was a reduction of the estate tax exemption to $3.5 million. The concern was, well, the difference between the $3.5 million exemption when the client died and the $11 million gift is $7.5 million. Will the service claw back, bring in that excess gift and tax it? The regs say, in fact, no. So there is an anti-clawback. So we're not concerned, since these regs have passed, that if a larger gift is made now and there's a reduction in the exemption amount in the future, that the service will pull that back into the estate. So it's a use it or lose it time. By transferring assets now, our clients can protect up to $11.58 million for individuals, or up to $23.16 million for married couples, and assets from estate gift and GST tax. And that's what we'll be talking quite a bit about in the strategy section coming up in just a minute. There's also a threat to the income tax basis adjustment at death. The income tax basis adjustment, a lot of people use the term step up in basis. So under current law, each asset that's included in a decedent's estate receives an income tax basement adjustment, as I mentioned, what we typically call a step up in basis, so that the asset's basis equals its fair market value on the date of death. So upon the subsequent sale of the inherited asset, let's say by a child, that child realizes capital gains only to the extent of the asset's appreciation of value since the decedent's death. In this way, capital gains realization can be reduced or eliminated just by owning assets at death. So quick example, client bought Apple stock at $1,000 some years ago. Now it's worth $10,000. If that client were to sell the Apple stock, the increase in value, the $9,000 difference between what he purchased it for and what he sold it for, is capital gain that would be taxed. If that client gifted that Apple stock to a child and that child sold the Apple stock, she would have the same capital gains as the parent did. The $9,000 that would gain, that would be taxed. If instead the child received that Apple stock after the client passed away, there would be that basis adjustment, and the basis would then be $10,000 on that Apple stock. She could sell that Apple stock the next day and avoid capital gains on it. The reason it's actually called an income tax basis adjustment is, although we don't see it too often these days, the basis actually could be lower. The fair market value could be lower, at death than the basis. We saw this most recently in a large scale in 2008 and 2009. People bought real estate at the height of the market, and then there was the significant decline in value of real estate post 2008 and 9. And if a client passed away there and the fair market value of that real estate was lower than the purchase price, well, that was a step down in basis. So just although we call it a step up, it doesn't always go up. Presidential candidate Joe Biden wants to end the basis step up at death so that the decedent's beneficiaries will receive the decedent's basically original basis, carryover basis inherited assets, effectively increasing the collectible capital gains tax in coming years. This would be significant change. So what does all this mean for our clients? As I mentioned earlier, we're in a somewhat use it or lose it time, as we'll also talk about in some of the strategies, of very effective strategies that we'll review. We're also in a bit of a perfect storm because interest rates that are required and to be utilized by the IRS with some of these techniques are at historic lows. So planning now around this is pretty imperative for many clients. So if you have clients whose estate may be subject to estate or gift or GST taxes, well, as the slide says, estate and GST tax at death, we should really consider lifetime gifting strategies now. So this is not just for the individual client that has $11 million of assets or married clients that have 23 million or more. But we also want to consider those clients that have this, that are in the $6 million to $12 million range in case the current act sunsets, or start to look for those clients who have assets between the $3.5 million to $7 million range if the Biden plan gets put into effect. So we're really looking at clients that have individuals 3.5 or more, married couples $7 million or more, to at least explore these issues. And certainly if they have higher net worths or larger estates than that, something to strongly consider. And we also want to remember, I'm talking about the federal side of things. Massachusetts, as you're probably aware, has a separate estate tax at a much lower threshold. It's $1 million threshold. And there is no gift tax in Massachusetts, however. So a lot of these techniques won't be affected dramatically. We're not as concerned with the Massachusetts estate tax rules when we're talking about this, but it certainly will make the Massachusetts estate tax exposure that much less in utilizing any of these techniques as well. I was hopeful last year when that there might be an increase in the Massachusetts estate tax threshold, the $1 million threshold, when 10 different bills were proposed at the state level. Nothing has really happened with those 10 bills, and now in the current economic environment, it's not just the federal government that's worried about decreased revenue due to taxes and increased spending since the pandemic. It's also at the state level. I don't know, so I'm not hopeful at all. And most of my clients that I talk to have a similar feeling. They can't fathom anyone coming in and reducing taxes at this point. They're pretty much by consensus is saying belief that taxes are going to increase. So I'm although those 10 bills are still there and pending, I don't think there's going to be any action on those by the end of this year. So let's take a look at some of the estate tax planning and gift tax planning strategies to consider to prepare for the potentially disadvantaged law changes. So here's the different techniques we're going to explore. One's intrafamily notes and intra-family sales. Something known as swap powers for basis adjustment. A lot of what we're doing and examining is not just estate tax, but it's now a lot on income tax and capital gains tax planning. We're going to look at a grant or retained annuity trusts and how they work. Also installment sales to intentionally defective grantor trusts, spousal lifetime access trusts, and irrevocable life insurance trusts. So you're seeing a little bit of the alphabet soup that us estate planners use when we have GRATs, IDGITs, SLATs, and ILITs. But let's start with intrafamily notes and sales. As I mentioned earlier, the federal interest rates are at a historic low. We see that a lot of people are refinancing their homes now, so we see it on that level. But in most of the techniques we'll be talking about now, the IRS mandates that we use certain figures or certain rates that the service publishes monthly. One is known as the 75/20 rate, and in this month, that rate is at 0.4%. Other rates are what are known as the applicable federal rates, AFRs. There's three levels. One is a short-term rate, so that's if there's a note of 0 to 3 years, the interest rate that's required, a minimum interest rate of 0.14%. For mid-length terms, which is more than 3 years up to 9 years, we're looking at a 0.38% interest rate. And then for long-term notes, which are anything longer than 9 years, it's 1.12%. So, they've never been lower in the history of these rates. So the first technique to consider is something known as an intra-family note. In this case, our client loans funds to a family member in exchange for a promissory note that charges an interest rate at the AFR. So if it's a 5-year loan, the AFR would be 0.38%. That's the minimum interest rate that could be charged without it being treated as a gift. So if the note was for less than a 5-year note, less than 0.38%, the service would treat that reduction in the interest rate as actually a gift. But the result of this intrafamily note is that the donor can provide a financial resource to a family member, certainly upon more flexible terms than a commercial loan. There's also a higher probability that the rate of return earned on the investment of the loan proceeds will exceed the loan interest rate. So as long as the funds donated are invested in a way that create more than a 0.38% interest and growth, all that appreciation passes to the child, the family member, free of gift and estate taxes. It's just not treated as a gift. In addition to the intrafamily note, there's also something known as an intrafamily sale, and that's where the client sells an income-producing asset to a family member in exchange for a promissory note that charges an interest rate at the AFR. So this is a sale of an asset versus a loan. The result, the income is taxed at the family's lower rate. So if this income-producing asset is creating more income than the AFR, that 0.38%. If our client retained this asset and is at a higher income tax rate, they're going to pay taxes on that income earned at a higher rate. If the family member's at a lower rate, well, that income will be at the lower family member's rate. To the extent that that loan recipient, the child, can invest the borrowed funds and generate a rate of return greater than that 0.58%, the appreciation and any appreciation passes to the child, once again, free of gift and estate taxes. So let's take a look at an example of this. So this is an interfamily exchange. Client loans money to family members who purchase an asset, or it could be a sale of an asset to the children. So let's say it's $1 million. And they have to pay that back in 3 years. So we have a $1 million loan to the family member. And this is at a 1% interest rate. In fact, if we were to do that today, I need to update these slides. A 3-year term would result in an AFR of 0.14%. So it actually would be lower. But so the client transfers those funds, takes back a note. What the government is saying when they say you have to use that AFR is you charge that, you get the full $1 million back. There should be nothing left to the children. So the children pay back over 3 years, $1,015,491.58. That's at that 1% level. It actually would be something less in today's interest rate, but let's just use this example. So the family members pay a monthly loan amount that includes interest at this historic low rate. And then at the end of it, the family members keep the asset, or if it was just funds borrowed and they purchase an asset that's generating high income, or they reinvest the asset for greater returns. At a 5, if they did that over the 3 years, at a 5% return on the investments, you can see there's more funds left over than what was paid back to the parent. There's about just under $65,000 transferred in this intra-family transaction. And it didn't use up any of the client's estate or gift tax exclusion. So basically that money was transferred to family members who are paying lower income taxes on it because they were at a lower income tax rate. And we've shifted out appreciation and greater return, gift and estate tax free. So something to explore. This works even better because $65,000 isn't bad, but this works so much better when we're dealing with discounted assets. So it could be interest in a family business, and we're getting able to shift something that has a fair market value of $1 million, but really the underlying assets are worth something significantly more. It could be $1.4 million. Then it's so much easier to hit a 5% or even higher rate of return, and that any higher rate of return than what we have here just increases the amount that's being transferred, gift and estate tax free. So that's the intra-family transactions. The next technique is what we call swap powers. So this is for capital gains purposes. So we talked about earlier, assets gifted during a taxpayer's lifetime do not receive a step up in basis at the taxpayer's death. That was the Apple stock that was gifted. There was no basis adjustment. The child would have to pay that, would have carryover basis. But if we're dealing with a situation where a client has a high basis asset themselves, and that client exchanges this high basis asset for a low basis asset that's in an existing trust. So maybe the client created a trust some years ago and put assets in that trust to remove it from their estate. And now that asset that was put in that trust has grown in value. Upon the client's death, there's no step up in basis on that asset in the trust. Well, we have a client here that has a high basis asset. So our client can not only minimize their estate income tax, but also take advantage of a basis adjustment at death. And they do that by swapping the high basis or exchanging that high basis asset that they own, where we're not so worried about capital gains, with the low basis asset. And the benefits of that, there's no gift tax. It's a swap. If they're the same, we want them to be about the same value. There's no gain recognition. And there's limited to actually typically no inclusion in your client's gross estate of the assets in the trust. But in this method, what we're doing is we're getting a significant capital gains adjustment at their death. So to take a look at an example here of how this could work, we have our client who removes a low basis asset from this trust, and this trust, the irrevocable trust, would be what we call a grantor trust for income tax purposes, and literally just swaps out the low basis asset. Let's say there was $1 million asset in this trust, but the basis was only $200,000, and the client literally swaps that asset for $1 million asset that the client has. And in this example, actually, the basis of that asset number 2 has a higher basis than the fair market value. So there's a shift there. Then at death, assets one, which now the client owned because they swapped it from the trust back to herself at death. That asset is received by the children and gets a step up in basis. And let's say this is some years later, that asset one has increased in value from the $1 million at the time of the swap to 1.5 million. So there's been significant growth since the time of the swap to the time of our client's death. Therefore, the client's children, after the client's passed, and once the children have inherited this asset that received a step up in basis, can sell that asset shortly after death for the fair market value of $1.5 million, and $1.3 million in capital gains tax is avoided. Well, I shouldn't say that that's what the tax is, but the tax would be on the $1.5 million in capital gain. So that's a significant savings. Just by doing this swap. Had this not occurred, there would be capital gains on that because it was owned by the trust and didn't receive a step up in basis. And then going back to the trust itself, let's assume that asset number two never grew in value. It was worth $1 million at our client's death, but still had the higher basis of $1.5 million. That asset could be sold at a loss of $500,000 that can be carried forward to subsequent years and ultimately pass out to the beneficiaries when the trust is terminated, thereby saving the beneficiaries more future capital gains on other assets because they can take this loss. So that's the swap power. Now, another important technique that you may have heard of, I would assume if you've done any estate planning, you've at least heard of the term GRAT, or Grantor Retained Annuity Trust. A GRAT is a real efficient way to transfer the appreciation of assets to beneficiaries without using estate or gift tax exemption. Some GRATs we actually do use estate and gift tax exemption, but it'll be at a reduced amount, lower than the asset underlying value. So a grantor transfers assets to a GRAT with a specified term of years. So typically it's a short number of years. At the end of that term, or I'm sorry, at the end of each year, an annuity is paid to the grantor. And the sum of the annuity payment is equal to the principal investment, the amount put in there, plus an interest as determined by the federal government. We have to use the 75/20 rate, which I had mentioned earlier is at 0.4%. Any amount remaining after the payments of the annuity passes to the beneficiaries free of estate tax. So this is a two-term trust. It has an initial term where an annuity amount is being paid back to our client. And then when that's done, whatever's left in the trust passes to the beneficiaries free of estate and gift tax. And sometimes when we're doing some of these short-term GRATs, as funds are being returned to our client, we create another GRAT to shift out appreciation from those funds that are being returned. Just to take a visual look at it using an example, here we have a client who creates this irrevocable trust that's a grantor retained annuity, and that trust says, and the client puts in $1 million of assets, and by the terms of the trust, we design it to pay back his annuity rate for 3 years. And the interest rate it says 0.8%, but once again, with the current 75/20 rate, it's a 0.4%. So it'd actually be less than that. So that's the initial design. So what happens actually in the initial design, the service allows us to say those payments don't have to be the same each year. We can increase them by 20%. So we run a calculation to say, all right, we're putting in $1 million asset. We're going to get 3 payments out that are going to return from the trust, the GRAT, to our client. But what we're going to do is zero out this GRAT for gift tax purposes, but because what we're going to say is that the full $1 million is going to come back to our client. That's we set the annuity amount to return that full $1 million plus the interest factor, that 0.8%. So this is it's the services calculation that we're required to use, but it's based on a fallacy. But we take advantage of this fallacy. What the fallacy is saying is the service says if the GRAT by its term is returning all the asset value that was first gifted in at that 75/20 rate, there's going to be nothing left in the trust. But if we do these 20% increasing terms, that allows year one more of the principal to stay in the GRAT and increase the remaining beneficial amount that will ultimately go to the children. So after the 3-year payout, if this trust, the $1 million as invested, earned a 5% rate of return, they'll be left in the trust $95,000 that goes to the children, gift tax free, because we zeroed out the GRAT. Per the IRS's fallacy, it's saying that we're getting these funds the client's getting the funds entirely back. Higher interest rates just means there's going to be more left over in the GRAT. GRATs work really well with assets that we believe are going to increase in value. So, for example, if we know a client's going to be selling a business in the future and we put in a minority interest of stock in this business in the GRAT, we can also start off by taking a minority and lack of marketability discount on the fair market value, so that the $1 million asset going in for fair market value purposes could easily be worth $1.4 million. And then if the business, because that's what the minority discounts are all about. So it'll be pretty easy for an asset worth more than $4 million to produce more than a 5% return. And then if that business is sold in the future for significantly higher percentage than what or value, all that is going to be shifted out of the estate. So we've utilized GRATs to shift out significant amount of money in certain situations for little to no gift tax. They work very well from that perspective. So it's certainly a planning tool to consider. Another use of the GRAT that we're starting to use more frequently is something known as a upstream GRAT, where the beneficiaries after the initial term ends are not children, they're our client's parent. And it's when it works well, it's with a parent that does not have will have a lot of exemption left over. They really don't have much in the way of assets themselves. So if we put in a low basis asset, and when the client passes, when the term of the GRAT ends, and then this low basis asset shifts up to the parent, then when the parent passes, it can come back down to the family and get a step up in basis. So another opportunity there, utilizing GRATs, we call an upstream GRAT. Next technique that you may have heard of is called an installment sale to an intensely defective grantor trust. We're trying to shift appreciation out of the estate. I met with a client yesterday who is a fairly high net worth client, but he's still fairly young. His business interests have grown every year. So we talked about not just what his current estate tax exposure is, but if we even just put a 5% increase of the value of his assets per year over the next 10 years, how much his net worth would increase, and that would just increase his estate tax exposure. So one of the things we're looking to do is let's make sure we get that appreciation out of your estate. In addition, we typically, when we're doing these, utilize the discounting techniques I've mentioned several times, where we're squeezing the fair market value down through discounting techniques, and we're freezing the value, so we're getting the appreciation out. So this is one of the tools we consider, the installment sales to the grantor trust. This intentionally defective grantor trust does not mean that the trust is defective, but instead means that the grantor and the trust is treated as the same for income tax purposes. Just to clarify that, it's actually any income generated by the trust is treated as the grantor. Any capital gains is treated as it is actually coming from the grantor, and the trust is not. It's not the trust's. It's not imposed on the trust. So appreciated and income producing assets are sold to the trust in return for an installment note. For this to work, we usually have to seed a certain amount of funds into the trust ahead of time so that the IRS doesn't treat the installment sale as a gift to the trust. I wouldn't necessarily sell an asset to someone and take back a note from that person if they didn't own any assets. That would be a highly risky proposition for me. I would look to sell an asset to someone that has assets above and beyond what I'm selling this person. So the IRS has taken a similar position. So we want to have some value within this IDGIT before we actually sell the asset. So usually a gift is made of 10 to 15% of the value of the asset first, and then the client sells to the trust this asset in exchange for an installment note. Any appreciation and income produced by the asset sold to the trust will pass gift and estate tax free to the beneficiaries. The interest payments on the installment note are not taxable income to the grantor because it's a grantor trust. And the IRS says that it's like the client is taking income from one pocket and putting it in the other. There's also no capital gains on the sale of this asset because of the same reason, being a grantor trust. So that was this bullet point here. So no gain is realized. So just to give you a visual, the grantor seeds assets and then sells the remaining assets to the IDGIT. So we're going to sell $1 million of assets to the IDGIT, but before we do that, we gift $100,000 into the trust, and then the sale is made. And then and in exchange in that sale, the client has an installment note back from the trust with a 1% interest. That would actually be a lower amount right now. A 9-year installment note is a midterm note, so that would be a 0.38% interest rate. So it's a 9-year installment note with a 0.38%, but we'll use this example of 1%. So that would return $1,046,9124 in principal and income that the grantee would take back in installments. Typically with these structures, most frequently we'll use we'll design the installment note so that it's a balloon payment. So it's only interest that's paid for the first 8 years, allowing that full $1 million to compound and grow in the IDGIT. And then there's a balloon payment of the $1 million and the remaining interest payment afterwards. So that we're just allowing greater and greater appreciation. And once again, we typically do these with discounted assets. So all that appreciation passes to the beneficiary. So if the appreciation was 5%, we've shifted out just under $200,000 to the children, free of the estate. If it's a 10% return, you can see the increases on the rates of return and how we can effectively push more and more funds out. Once again, this works best with highly appreciating assets or high income producing assets that we can discount as we go in, where that 10 and 15% rate of return is more of an internal one with discounts. So we're usually achieving for that $1 million asset somewhere in that $500,000 to $600,000 going to the IDGIT beneficiaries free of gift tax. We can also utilize these these grantor trust sales when we want to benefit not only the client's children, but then there's grandchildren. And then whenever there's grandchildren as part of a trust issue, we're concerned about generation skipping transfer tax exemptions. So let's say this is a high net worth client and they're actually going to seed 10 million into the IDGIT. So we're going to use up most of their exemption amount. And then they have an asset, maybe it's a business that's appraised at $55 million. And that is what's transferred to the IDGIT in exchange for a promissory note. The appreciation passes to the beneficiaries and passes to them with what we call an inclusion ratio of 0 for GST tax purposes. That means all those funds in the trust after the note's paid back can be there for children and grandchildren and great-grandchildren without a concern of generation skipping transfer tax being applied as well. So this is similar situation, or we might call a generation skipping trust. A lot of people call them dynasty trusts. These are trusts that can last for multiple generations. We want this trust to be here for children, grandchildren, and great-grandchildren, and so on. So our client transfers funds with money or property into this trust. If designed properly, the trust administers the trust for the benefit of the beneficiary. So it's there for the children. When the children pass away, it can go to grandchildren without any estate or generation skipping transfer taxes coming through, and just continue to grow in that trust, passing from generation to generation with no transfer taxes. The Spousal Lifetime Access Trust, a SLAT, this is a really important tool when we have clients that are married. And what this tool will let us do, because some of the issues with these gifting to trust for children is clients may say, yeah, but that means I don't have any access to these funds. Well, with the Spousal Lifetime Access Trust, we're hopefully solving a lot of that concern. What happens is we have our client who's married gifts assets to an irrevocable trust, something that's designed in a way, and we call it a SLAT. The beneficiary of that trust is the client's spouse. The spouse may even be the trustee, and then we can have children and grandchildren as secondary beneficiaries as well. The spouse as trustee can manage those assets, doing whatever they feel is appropriate. They do have trustee obligation to manage assets prudently, but and can withdraw assets with what we call a HEM standard. They can withdraw it for purposes of their health, education, maintenance, and support, or we can have an independent trustee in there that can pull funds out for any reason and distribute it to any beneficiaries. But by having the spouse as the primary beneficiary and trustee, we really haven't lost control over this asset. The spouse, our client, uses their gift and estate tax exemption when putting money in. So let's say our client puts in $5-10 million in this SLAT, yet the spouse is in full control of it. The appreciation of the asset in the trust will go estate tax free and gift tax free. So if they put in a $5 million asset this year and they pass away in 15 years, and that $5 million is now worth $12 million, all that appreciation we've shifted out of their estate. The client can use all their gift exemption to lock in this historic high exemption amount that we've been talking about. And another important component of the SLAT is we've now taken that 5 to 10 million, whatever the amount is that's been transferred into the trust, and made it very asset protected. So if our client was subsequently sued because of an occurrence that happened after the creation of the SLAT, or the client's spouse is sued, or any children are sued or divorced, facing bankruptcy, all the assets in the SLAT are very, very protected. So we're doing really good tax planning, very good asset protection planning from liabilities, future potential liabilities, but haven't lost control because the client can rely on the spouse to access the funds in that trust. And we can have each spouse create a slat for the other spouse, thereby shifting from an estate and gift tax purposes, somewhere in that $22 to $23 million range if you wanted to use up all their exemption, yet still have full access to those funds. So very, very good technique. Not only, and we're locking in these high exemption levels right now, and it doesn't have to be for those clients that have the $11 to $22 million funds. It could be those clients that are in that $5-6 million range, but are concerned about possible reduction in the estate and gift tax exemption, and are concerned possibly about liability protection. So we're doing it for both the asset protection and tax planning. And that's what this last bullet is talking about, the added protection that's afforded with the slats. So quick example, married client creates the slat irrevocable trust, transfers up to that exclusion amount into the trust. It's a gift. Spouse is the beneficiary of the trust, and their descendants may also be beneficiaries. At the death of the beneficiary spouse, the assets are either distributed out to the children or are retained in the trust. And this can also be a dynasty, generation skipping transfer tax type trust as well. And then the last example I wanted to talk about are irrevocable life insurance trust ILITs. So as some of our clients have larger life insurance policies that haven't been much of a concern lately because we have such a high exemption amount. Well, if it does reduce to that $3.5 million level, the life insurance policy is included in their estate for estate tax purposes, and could result in federal estate taxes. So we'd like to remove the value of the life insurance death benefit from their estate and truly make it both income and estate tax-free, truly tax-free at that point. A lot of our clients think that their life insurance is tax-free. Generally, it's income tax-free, but it is included in their estate and could be taxed at their death. So what we do is we have an insurance policy that's either in existence and we want to transfer that to this life insurance trust, or if it's going to be a purchase of a life insurance policy, the trustee of the ILIT will purchase that policy. Our client makes gifts each year to the trust to pay the policy premium. The premium payments and the full death benefits of the policies, if done correctly and from a timing perspective, are not included in the insured, or if the insured has a spouse, won't be in the spouse's taxable estates, and the insurance policies at the death of the insureds will be exempt, as I mentioned before, from income tax as well as estate tax. So very, very important technique that's been around for a long time, but we've seen a lot. It hasn't been utilized to the same degree as it had previously when we had a lower exemption. Well, I think we need to start to revisit the ILIT. One of the issues with an ILIT too is if there's a high degree of cash value when we transfer a policy that has a lot of cash value, the cash value is basically will be a gift. So we want to be careful when we do this, and we'd rather do it when we have such a high exemption amount than if it's reduced in the future. Also, if that policy is in existence and transferred to the ILIT, there's the 3-year contemplation of death rule, which basically says if it was an existing policy that was transferred into the trust and the policy owner passes away within 3 years from the day of the transfer, it's as if we didn't do it. It all gets pulled back into the estate. So we do have a timing perspective where if the trustee purchased a new policy, it's out of the estate immediately. So a quick look at how this might work. I have a client that has a $5 million insurance policy. The client has assets of $11.58 million, just perfect for tax planning purposes, and the wife has assets of $11.58 million as well. If that at the death of the client passes away, there's no taxes due because of something known as the unlimited marital deduction. As long as the wife is a U.S. citizen, there wouldn't be a tax. The $5 million death benefit from the insurance goes to this wife. They had done some baseline planning, so the husband's assets go into a family trust, so it won't be included in the wife's estate for federal estate tax purposes. And then the wife has assets of $11.58 million. Then when the wife dies, assuming no appreciation, there's 28.16 million in total assets, but what's taxable is the wife's assets of 11.58 million and the $5 million of life insurance death benefit. So that would create a $2 million tax. If we use the life insurance trust to own that policy at the husband's death, that $5 million doesn't go to the wife outright. It stays in the ILIT and will be removed from her estate. So when she passes away, we've sheltered not only the $11.58 million in the husband's family or credit shelter trust, we've also sheltered the $5 million of insurance. Therefore, instead of $2 million estate tax is due, it's a zero estate tax situation. So that's the presentation. I moved it a little faster than I had intended, and I apologize for that. I just didn't want to hold you up because of our late start. Wanted to talk about what's next. So if you have, several different thoughts are, if you have clients that you think should seek counsel on these issues, I'd be happy to talk to you about them. If it makes sense for them to come in and meet with us, when clients are referred to us, we waive our initial consultation fee of $595. We'd be more than willing to, after we talk to you about particular clients, if we think they're a good fit, we'd be happy to waive that fee to benefit them. If you have clients or part of a group that you think would benefit from a webinar, more of a client-focused version of this, be happy to talk to you about that, maybe a client appreciation event, webinar, or any organization you might be part of. We'll try to make sure that we don't have the technology issues that we had earlier. So be happy to talk to you about any of these things, or if you have follow-up questions, be happy to talk to you about that. Thank you for attending. I'm going to take a quick look at the questions. Most of the questions were really regarding the technology issues, but there was one regarding the SLAT and asking if there's nursing home protection with the SLAT. There really isn't. Just the way the Medicaid rules work with the SLAT, you're not going to get nursing home protection. The only way a SLAT, it couldn't be a SLAT. It would have to be for the benefit of people other than the spouse and our client. We'd have to fully remove them as beneficiaries from that to get nursing home protection. The Medicaid rules are just, although also created by the federal government, they're vastly different than the tax and estate tax rules. So somewhat long answer to a simple question. The simple answer is that a SLAT does not afford nursing home protection. The question is, are there annual tax returns for an ILIT? So that's a great question. It depends on whether the amount of the gift tax premium that's being gifted annually, and if that premium exceeds the number of what we call crummy beneficiaries within the trust, then we would have to file an annual gift tax return for the excess premiums. Some practitioners take a very conservative approach and do file gift tax returns for annual premium payments just to demonstrate and just to have a historical payments there, but showing that they're zero. But technically, there shouldn't be annual gift tax returns due for an ILIT. If the tax return you're talking about is more of an income tax return, then unless there's more than the insurance policy in there, so there's excess assets beyond just the insurance policy, and those assets are being invested in a income producing way, someone's going to have to pay tax on that income. Most of the ILITs we draft are grantor trusts, so that if there are additional income created in the ILIT due to excess investments in there beyond the life insurance policy, that tax is paid up over to the grantor, the client, and they note that on their return. So typically we don't see an annual income tax return on the ILIT. And typically with the ILIT, there aren't additional assets or significant assets in there producing income. If it's a cash value policy, any of the income generated by the cash value component, there's no income tax on that, just like any other life insurance, whole life permanent product. There's no income tax on the cash value component and the investments within there. And unless there's any other questions, I'll want to thank you at this point. And I'm happy once again to talk to any of you about any of the questions you might have that you weren't able to put up on or wanted to talk to me separately about. And I wish you a good rest of your day. Thank you.